How much is the Fed sort of playing puppet master with this stock market right now, if at all?
Well, I think they're playing in a big way. I mean, I felt last week there was some talks that maybe they were being a little bit less hawkish. I don't really know where that came from, because basically everything I heard was adamant that they're going to stick with fighting inflation. They're going to even signal that not just 2 more 50 basis point rate hikes, but even a third. Maybe one in September. I guess my biggest concern out there is that some of the people who are saying a reason to be bullish is that the Fed is going to stop. They're not going to tighten as long as people thought, or as aggressively as people thought. Well, they're telling us right now is that they are. So therefore, the only reason why they wouldn't is to be, number one, if we had some sort of freezing up in the fixed income markets like we saw in 2018 and 2020, or if the economy slows down so much that that they need to come in and stop tightening so much. Both of those instances takes the stock market a lot lower before they do it. So if you're looking for if you're looking for the Fed to stop tightening or to not be as aggressive later this year, you should actually be bearish, not bullish.
Okay, why does it take the stock market down? Has the stock market not already priced in an economic slowdown?
I don't know, not at all. As a matter of fact, all they've really done is priced in the fact that we no longer have the stock market. I'm sorry, we no longer have the Fed adding massive amounts of liquidity into the marketplace. I mean, we started the year at 22 times earnings. Now we're at 18. That's still on the expensive side of things. And with the economy having been, with GDP estimates in the last 6 to 8 months have been cut in half. It's only a matter of time before the earnings estimates come down. So really, if that E part of the PE comes down, like I think it will, we're not trading at 18 times earnings right now. We're retrading at 20 times earnings. So it really hasn't priced it in. We're getting a 1-2 punch. The first punch was one from the Fed removing liquidity that took the market well above its underlying fundamentals. The second punch is going to be that slowing in the economy, and that's going to bring us a lower, I think, with lower lows before we bottom.
I mean, listen, Matt, we talk a lot about inflation. We've been talking about inflation, by the way, for about 1.5 years on this show. How confident are you that the U.S. economy will slow down? Could it surprise you to the upside?
Well, of course, anything can happen. But, right now we're looking, again, the inflation is supply driven. That means we have stagflation. That causes stagflation. People say that stocks are a positive, are a hedge against inflation. I don't know what planet they're living on. It's only a hedge against inflation when it's demand-driven inflation. We have supply-driven inflation like we had in the 1970s. That wasn't good for the stock market. I don't think it will be now. I don't want to sound overly bearish here. Some of the reasons that people are thinking that the market's going to rally from here just don't seem to add up to me, with GDP growth estimates coming down in a serious manner. Everybody's looking for the economy to slow. Whether we get to recession or not, I don't really think is all that important.